Hey traders, Jason here from Leavitt Brothers. So in this video, I'm going to talk about what we consider to be the current state of the market. A lot of things are happening, or maybe I should say not that much is happening because the market has actually been very quiet lately. A lot of news, but the market itself has been very quiet. The ranges have been getting smaller, volume has been dropping. It's been very little up and down movement. It's actually been very, very quiet on Wall Street, which is, you can say it's a good sign, it's a bad sign, whatever. But let's go through the state of the market. I'm going to show the indexes, the weeklies, and the dailies. I'm going to show a couple breadth indicators. I'm not going to do too many charts because I only think it takes a couple charts to really paint a picture of what's going on right now. Before I get started, a quick reminder, we have an open access period right now at Leavitt Brothers. You can join at the link here, leavittbrothers.com/members/7766.cfm. No credit card needed. You can check out our research, check out our analysis, see what stocks we're playing right now, etc., etc. No risk. Doesn't hurt to try us out. You've been watching our videos for, many of you have been watching our videos for a couple of years. Why not check us out? See how we operate inside our website. All right, let's get to the current state of things. All right, so here's the weekly chart of the S&P 500. Big rally 2020-21, fell 20% in 2022, and over the last year, the market has been trading in a range, as you can see. Okay, it's been very quiet. There's been some ups, there's been some downs. Directional moves have lasted 1 to 2 months. They have not gone far. They've reversed, and that's that. We have a pretty stiff resistance level here at 4,200. I'm going to get rid of these. The range here from 3,800 to 42 measures up to 4,600 if we can get a little bit of momentum going. But overall, the market's been flat. It's been range bound. Bulls, bears, they battle it out, but in the end, nothing has changed. Nobody has won. If you go onto Twitter, there's people who are pounding their chest about the market has bottomed and is going up. There's other people who are saying this is nothing more than a bounce within a downtrend. Bottom line is the market's been flat for last year, and it's very, very neutral, and there's nobody really is in control. You could maybe argue that it's leaning a little bit to the upside because we got to move up here above the 50. It lost it, but then it got back above the 50. So even if it rests up here, maybe test the 50 one more time, you could maybe argue that it's leaning to the upside. But until we get a definitive break above 4,200, I don't think anyone could be that comfortable digging their feet in and defending a position. The bottom line is we've been flat for an entire year with no directional movement lasting very long. Here's the NASDAQ. The drop in 2022 was bigger, but it's setting up pretty nicely right now. We got a double bottom here, then it rallied to a higher high, took out that high. One last dip here, as you can see, and for the last 6 weeks, this is a weekly chart, it's been very, very quietly settling in with an easily definable resistance level. A lot of big black volume bars here, which is good. So again, it was weak. Now it's neutralizing. Over the last year relative to here, it is completely flat. So just like the S&P, a little bit different movement, but overall it's flat over the last year. It's leaning to the upside right now because I see the 50-day moving average coming down here and flattening out. So I kind of lean to the upside for sure. But I don't think it's not like a 90-10 bias. It's more like 60-40. I think the market has a potential to break out and run a little bit here. But it's not a strong bias because it just doesn't deserve to be a strong bias based on the groups that are leading, which I'll talk about in a minute. Okay, one more weekly chart. This is the IWM, so it tracks the Russell 2000, and it too is flat, as you can see. Okay, stocks, the stocks moved up, it's moved down. The most notable here is just the fact that the S&P 500 and NASDAQ are near multi-month highs, while this is down. Not a ton, but quite a bit, enough to be noticeable. A lot of that's due to, oil's weak. It's been weak for a little while. And of course, regional banks are extremely weak. They're all down, or I should say like 95% of them are down quite a bit just in the last couple months. And that's the main reason why IWM is down so much. So S&P 500 flat over the last year. Same thing with NASDAQ. Same thing with the Russell 2000. Everything is pretty flat. And even if you look at this, the moving averages here are the 8, the 21, the 50, and the 200. All of them come together right here. So no matter what look-back period you look at, the index is unchanged going back pretty much all of them. So rallies get sold, dips get bought. You could argue that as bad as things have been, rates have gone up a lot, and mortgage rates are up a lot, so it's harder to afford a house, and we've had a whole bunch of bank failures and others that are really, really struggling, and yet the market has held up pretty well. So on a relative strength basis, how the market is acting relative to the news, that's actually not that bad. All right, let's look at the daily charts. S&P 500 going back 1 year, just a big fat sloppy mess. It's gone up, it's gone down. Nothing has lasted more than about 2 months. You could argue here that with the move from like 3,800 here to 40, almost 4,200 up here, and we got a test of the 50, moved up, test of the 50, now moving up again. You could argue that like this is actually pretty impressive. Okay, we got the first of the bank failures took place like over here. And the fact that the market is up and just consolidating while other banks have failed and the Fed raised rates and we've had some earnings disasters, again, relative to the news, that's pretty darn good. So that's why my bias leans to the upside. But again, it's not a strong lean. We could bust out here and run, but some other things are going to have to be in place, for that run to last any length of time. Here's the NASDAQ. Looks really good in the near term. Going back many months, it's unchanged, but in the near term, this is good. Bottom here. So we got a double bottom, moves up, comes down. That's a pretty big move down. Certainly was not very comfortable for the bulls, but then we move up and we solidify resistance here. Several touches here, a test of the 50 here, a higher low here. It's actually looking pretty good. Again, if I would have told you over here, let me get rid of those. If I would have told you over here, we're going to have a mini banking crisis. Numerous banks are going to fail. Second, third, fourth biggest banking failures in the history of the U.S., you would have never guessed that we'd move up and just sideways over the 2 months that followed. So the fact that the indexes are acting better than the news is a little bit encouraging. All right, one more index chart here. Here's the Russell 2000. No surprise here. So while the S&P and NASDAQ are up near their highs, the Russell is down a bunch. I mean, in fact, it's like 1 or 2 bad days from being at a 6-month low. How high can the S&P and NASDAQ run without the small caps? I don't think they can. Certainly pop and run for a week, maybe a little bit longer, but they're not going to run far unless the small caps at least come along and participate. They don't have to lead. They don't even have to keep up to the same degree, but they can't be making like multi-month lows at the same time the rest of the market is moving up. Okay, so we need improvement here if the market's going to try to leg up from here. All right, let's look at some breadth indicators here. So here's just S&P 500 up top versus the NYC 80 line, the 5-day moving average of it. So as the market has been resting, moving in a sideways range the last 4 or 5 weeks, you can see the 80 line has been declining. So that tells you the market's getting thinner. Okay, day after day, decliners are leading advancers. So it's not really that encouraging. You can see divergences have played out in both directions, positive and negative, and they have typically led to reversals. So you could argue that over here the market is correcting with the passage of time and letting this indicator cycle down, and hopefully it will catch a bid and move up. Or you could just simply say, as this is moving sideways, negative pressure is building, and eventually that negative pressure is going to lead to a move down. It's kind of like what happened over here when the market moved up and then sideways while AD line was trending lower, and eventually it fell. Okay, when it falls, it doesn't have to crash. Okay, that doesn't mean like a big bear market's going to start again. It just means it needs to let out some air, let the indicators cycle down and start over. So this is a concern. Okay, market moves up and sideways, and the AD line is trending lower for 5 weeks. That's definitely a concern. Okay, if the S&P 500 is right near its high and like ready to bust out and run, and yet beneath the surface, decliners are beating advancers. Like that's worrisome. All right, next one. This is S&P 500 up top versus the breadth thrust indicator, which is a 10-day moving average of advancing volume versus total volume. Same thing. So the 80 line lets every stock count as one. So it doesn't matter if you're Apple or some small company that's only worth $1 billion, they count equally. When you're talking about volume, obviously the bigger stocks that trade a lot of volume have more influence. It's not always that way because sometimes you have smaller companies that trade a lot of volume, but for the most part, the bigger companies trade more volume. So you get a little bit different message, but in this case, the message is the same. You got the market moved up and sideways, and advancing volume as a percentage of total volume has been declining for about 5 weeks. So it's a little bit of a concern that the market is getting thinner as it's moving up. Okay, next one here is S&P 500 up top versus the Russell 3000 stocks above their 50-day moving average. So the market moved up here, and the percentage of Russell 3000 stocks above their 50-day moving average was up at 80%. The market then dropped and then recovered, but this dropped and barely budged. Okay, so this is 80%, this is 40%, even though the market fully recovered. So, a lot of stocks participated in this, and then a lot of stocks were left behind on this run here. So the market is getting thinner, less stocks are participating. As of right now, even though the market is literally 1 or 2 good days away from a 6-8 month high, we have less than half the stocks are above their 50-day moving average. It's not a high bar to get over, and yet we don't even have half the stocks above it. All right, next one. Last chart, similar situation. This is the S&P 500 up top. Down below is the percentage of stocks, actually the number of stocks that are at a 1 month high. Okay, so when the market rallied here, you can see lots of stocks above their clicking a 1 month high. Market drops, so of course this is going to drop, not a problem. But then the market rallies all the way back up. So we got this nice rally here. The S&P 500 went from close to 3,800 up to 4,200. So it was a nice 400 point rally, which was better than 10%. And look, a little bit of an uptick, but not much. Okay, so lots of stocks participated in this rally here. Many less stocks participated in this rally here. Okay, the S&P 500 is just a good day or two away from a 6 month high, and yet there's this indicator is just 1 month high, and yet look at how many stocks have been lagging. Not that many stocks are sitting right at their right at the edge, ready to make even a 1 month high, let alone a 6 month high. You could argue that this indicator could break out as it did there. Okay, and it's certainly possible. I'm just saying so far it hasn't. Okay, so overall, we have S&P 500, NASDAQ are close to resistance. They can try and break out and run at any time. Small caps are lagging by quite a bit. And when you look beneath the surface at the internals, they don't look that great. Okay, there's definitely a lack of participation. The market's is not very broad-based. The strength isn't very broad-based. It's getting kind of thin. So if the S&P tries to break out, the internals need to improve really quickly, or the breakout is not going to go very far. That's just the way it is. You got to call it as we see it. It can try and run. It's just not going to run far unless we get better participation. All right, thanks for watching. And again, remember, Leavitt Brothers Open Access. Check us out. There's a link below the video here. All right, good luck. We'll see you next time.